Good morning, ladies and gentlemen. Welcome you all to 4Q FY26 results conference call of Sagar Cements Limited. From the management team, we have with us today Mr. Srikanth Reddy, Joint Managing Director, Mr. K. Prasad, Chief Financial Officer, Mr. Rajesh Singh, Chief Marketing Officer, and Mr. Raja Reddy, the Company Secretary. I would now like to hand over the call to Gavin Desa from CDR India for his opening comments, post which we will hand over the call to management. Over to you, Gavin.
Thank you, Vibha. Just to add, we will begin this call with opening remarks from the management, following which we will have the floor open for an interactive Q&A session. I would also like to point out that while some statements made in today's discussion may be forward-looking in nature, a note to this effect was stated in the Concall invite sent to you earlier. I would now like to hand over to Mr. Srikanth Reddy for his opening remarks.
Thank you, Gavin. Good morning, everyone, and welcome to Sagar Cements earnings call for the quarter and year ended March 31st, 2026. Let me begin the discussion with a brief overview of the market, post which I will move on to Sagar-specific developments. As indicated earlier, overall demand during the quarter remained resilient, particularly in the first 2 months, supported by a sustained construction activity. However, momentum moderated towards the later part of the quarter due to labor shortages during the festive season and the impact of the unseasonal rains. The pricing environment also remained stable, largely driven by improvement in realizations in the non-trade segment. Moving on to Sagar-specific developments, during the year, we completed the minimum public shareholding requirement in Sagar Cements, in Andhra Cements, through OFS, providing added financial flexibility at the parent level. We also closed the year on a strong note, with volumes for both quarter and the full year growing by 8% and 11% respectively. Our total volumes for the year stood at 6.1 million ton, broadly in line with our expectation, reflecting steady execution despite a dynamic operating environment. Demand remained resilient across our key markets, particularly driven by sustained traction in infrastructure and rural segments, which supported the top-line growth of 20% during the quarter. Revenue were also added by favorable pricing trends in the non-trade segment, leading to an improvement in overall realizations. Looking ahead, we remain optimistic about the demand outlook across our core regions. Continued construction activity, supported by government-led infrastructure spending and stable rural demand, provides a strong visibility. Based on this, we expect our volumes to be in the range of around 7 million ton for FY27. On the operational front, our EBITDA per ton for the quarter stood at rupees 445 as against rupees 218 per ton reported during Q4 FY25. Going forward, we expect profitability to improve, supported by structural cost efficiency initiatives. These includes benefit from WHRS, an increasing share of renewable energy through solar power, logistics optimization, and efficiency improvements from ongoing plant upgrades. Power and fuel costs stood at rupees 1422 per ton as against rupees 1406 per ton reported during Q4 FY25. Freight cost for the quarter stood at rupees 848 per ton as against rupees 822 per ton during Q4 FY25. From an operational point of view, Mattampally plant operated at 59% utilization, while Gudipadu, Bayavaram, Jeerabad, Jajpur and Dachpalli plants operated at 84%, 69%, 95%, 44% and 38% respectively during the quarter. During the year, the group opted to be taxed under Section 115BAA of the Income Tax Act 1961. Accordingly, deferred tax assets and liabilities have been remeasured. The group has recognized the deferred tax asset on the carry forward business losses and unabsorbed depreciation in Andhra Cements Limited based on projected future taxable income, which provides convincing evidence that sufficient taxable profits will be available to utilize the losses. Profit after tax for the quarter stood at rupees 100 crore. As far as the key balance sheet items are concerned, the gross debt as on 31st March 2026 stood at rupees 1672 crores, out of which 1379 crores as a long-term debt, and the remaining constitutes the working capital. The net worth of the company on a consolidated basis as on 31st March 2026 stood at rupees 1861 crore. Debt equity ratio stands at 0.74:1. Cash and bank balances were rupees 107 crores as on 31st March 2026. On the capex front, the company has successfully commissioned 2.8 megawatt of the waste heat recovery system pertaining to the AQC boiler out of the 4.35 megawatt on 12th May 2026. The balance capacity of 1.55 megawatt relating to the preheater boiler is expected to be commissioned by end of June 2026. Further, our expansion projects at Dachapalli and Jeerabad are progressing, and we remain focused on executing these projects within defined timelines and budget. These expansions, along with our existing surplus capacity, position us well to capture the incremental demand. The board of directors of the company in their meeting on 30th March 2026 have accorded in principle approval of amalgamation of the Andhra Cements Limited subsidiary company with Sagar Cements, subject to necessary approvals from the authorities concerned under Section 230 and 232 of the Companies Act 2013. Further, the board of directors in the meeting held on 13th May 2026 approved the establishment of a new division, the Superfine Building Materials, to capitalize on the growing demand for advanced, durable, and eco-friendly construction solutions. The division will focus on high-performance superfine materials derived primarily from our GGBS and fly ash, catering to precision construction and sustainable building applications. These products will support applications such as ultra-high performance concrete, structural repairs, interior finishing, and cladding solutions. The initiative aligns with the company's long-term growth strategy and aims to strengthen its presence in advanced building material segment. Overall, we are confident of sustaining healthy growth over the medium to long term, supported by capacity additions, operational efficiencies, and business diversification. That concludes my opening remarks. We would now be glad to take any questions that you may have. Thank you.
Thank you, sir. So we will now begin the question and answer session. Anyone who have the question can ask through raise of hand or through chat box. We will wait for a minute for questions to assemble. Meanwhile, sir, first question is from my side. Sir, can you please elaborate more on the expected cost higher impact that we can see in the coming quarter because of the West Asia crisis?
Yeah, Vibha, as you would have seen, the petcoke and the coal prices are on an uptrend, which we did indicate in our presentation. But fortunately, in our case, the inventories of the fuel is relatively available till middle of Q2. We do not expect a significant cost increase in a short term, but on a medium to longer term, yeah, we have to see the outcomes of the war. But as it stands, the petcoke prices are on an increasing trend. From what we used to be close to around 120, is already hovering around 136 to 140 dollars on a CIF basis. So that should invariably add up another 200 rupees up to clinker level. At cement level, it should definitely add close to 100 to 150 on the current kind of a blend for us. But we expect things to shape up better and fairly quickly. But we have inventories all the way up to middle of Q2.
Thank you, sir. Next question we have from Mr. Rajat Setia. Sir, please go ahead with the question.
So, sir, you were saying that we won't be impacted till middle of next quarter, like Q2, and the prices that have gone up so far, the impact is 100 to 150 per ton basis. Is that what you are saying?
On a cement basis, yes, Mr. Rajat Setia. at the current price trends that we see in the market, where the petcoke landed cost and everything we did indicate in our presentation, when it fully starts impacting us, I think that should be the net impact on us too. But we see that impacting us from middle of Q2 onwards if prices don't come down
Okay.
from here.
And have we started stocking up inventory at current levels, or we are waiting?
Not yet, not yet. I think we are still in negotiation. Uh, we are switching to some amount of domestic coal. So we are still evaluating options to source mostly domestic. Uh, our ability to switch to any of the fuels is helping us to focus more on domestic coal. How much of imported coal substitution would be known probably by end of this quarter itself, Mr. Rajat. So we'll be in a much better situation to communicate exactly what the real impact is going to be for us by end of this quarter.
Okay. And sir, other expenses have gone up by 28% on Q-on-Q basis. So is there anything that you can share to understand this?
Yeah, Prasad here, sir. I will update on that. There are one-off expenses for the quarter. There is a mine-bearing lands as it's a close to 7.5 crore we considered during the current year. And also there is a one district mineral foundation, which is one of the subsidiary, relates to one of the subsidiary company, that is Sagar Cement CM Private Limited. Is a close to 3.24 crore we considered during the quarter. Both put together close to 10.5 crore, one of the expenses we considered in the current quarter.
Okay, that is the only one-off, but the
Yeah.
overall other expenses, if you look at, they are 700 plus. So even if we remove 100, 10 crores, so then the impact, I mean, the growth, which has been 28%, will come down to 26. So everything else, would you say is normal, or?
Yeah, rest all is normal in line with the operations. These two elements are the one-off expenses.
Okay, so has anything shot up in this quarter in terms of the prices, and why that's why this is up so much? Because even on a year-on-year basis, it is up 14%. I mean, just trying to understand whether this 700 crore of cost base is the normal cost base on a quarterly basis.
There are a couple of promotional activities we spent during the quarter. So that's what it's a part of the other expenses. So yeah, I will give you in detail, sir, post this meeting.
Sure. I mean, the idea is to understand whether the cost base at 700 crore is going to sustain, or how should we look at it? And so second, if you can talk about how is the current quarter progressing in terms of the volume and the pricing?
Yeah, Mr. Rajat, the current quarter progress on a volume front, year-on-year number is up of 7%. Uh, it's reasonably progressing in line with what we have indicated for a 7 million for the complete year in terms of our volume outlook. Though there is some amount of slowdown because of the elections, where the labor outgo and they coming back, we expect things to start stabilizing before end of this month. But for that, we see a very strong demand outlook for the current year for most of our operations, Mr. Rajat.
Answer pricing compared
Yeah,
to
pricing from middle of April to now, the prices have been stable. From exit of March to the middle of or rather end of April, the prices picked up by almost 25 rupees per bag, and more or less from then on it has remained flat in our case, Mr. Rajat.
Okay, thanks. So last one. Last couple of years, I mean, you must be seeing that the volume guidance that we talk about at the beginning of the year, we generally are not able to meet it because of various reasons. So now that we are targeting 7 million tons, which is 15, 16% kind of volume growth, maybe 15%.
Mr.
So do
Rajat,
you
you should note, like last year we did indicate close to 6 million. We crossed 6.1 million. So we do expect even in the current year, the 7 million target that we are trying to achieve is purely because of the ramp up. Because you should be aware that our Jeerabad plant is upgrading itself, and we are hopeful that before the end of this quarter, the plant upgrade would happen by additional 500,000. And at the
Mhm.
same time, ramp up of Andhra Cement also is happening both in terms of capacity, but notwithstanding the capacity expansion, we do expect a ramp up at Andhra level. That is the reason why we are expecting a zero point 0.9 million ton kind of an additional volume. Though the markets that we operate are likely to grow anywhere between 12 to 15%, we did not pencil in the entire 15% growth for ourselves in the region alone. There is an 500,000 ton, and for more than 3 quarters, the incremental 500,000 should be available in Jeerabad, where we have always been operating up of 90%, Mr. Rajat. So, yeah, we are hoping that to be very close to the indicative target, Mr. Rajat. Last couple of years, as you know, the prices did not support us for volume growth. We usually don't want to lose cash for the sake of volume. So we probably would have underperformed on the volumes purely on account of not wanting to lose money. We don't chase market share. We actually conserve the cash. That is our philosophy, and that remains. But given the current demand outlook and the current pricing kind of a thing, we are more than hopeful to achieve 7 million tons, Mr. Rajat, for the current year.
Thank you so much and wish you all the best.
Thank you, sir.
Thank you. We will take next question from Mr. Raghav Malik.
Yeah, hi, sir. Thank you for the opportunity and congrats on a good set of numbers. Just a few questions on this superfine building materials division that we're setting up. So, I understand, that's might be a little similar to, the one existing player that has started off with GGBS. Is there some sort of cost synergies we also have in this space, or like is there some advantage to getting into this venture?
Yeah, Mr. Raghav, good morning. See, it's an extension for our existing business because we are in GGBS space. We have been one of the old players in the GGBS space, but we are limited to only two of our manufacturing facilities, one at Bayoram, that is close to Vizag in Andhra, and Jajpur in Odisha. Uh, we have access to both fly ash as well as the GGBS. As I mentioned, there are advantages because we do produce GGBS and we need to invest a very minimal amount to separate superfines. Currently the GGBS is sub 4,000 blane on a fineness. Uh, with a minimal investment, we could separate the fines that come out of the production. Our target is to look at anywhere between 10 to 20,000 kind of a blane separation for both fly ash as well as GGBS, along with microsilica. Yeah, these products primarily cater to advanced construction material and also into the high performance concrete, sir. We are already in that segment, especially we do have a very strong relationship with players who would definitely need this product going forward, especially into the precast segment. So we are leveraging on our relationship, but at the same time, our target is to get into advanced building materials, which are very sim to the product range that we already have. We are also looking at some of the innovations and the technical solutions we that we want to offer. Part of that, this is the first step towards giving advanced solutions where we could definitely do a lot of value add to ourselves as well as to our customers, Mr. Raghav. And we would be more than happy keeping the stakeholders updated on the progress that we are making. This is only a first step towards getting into a much higher end and technically advanced kind of solutions and the materials that uh, as a company we would want to enter, Mr. Raghav.
Sure, sir. And any kind of, longer term, maybe volume targets from this? And also, like, is there some indication of versus, current products in the advanced space or just cement? What would the kind of premium maybe be in terms of pricing premium or discount for some of these products?
See, I would not like to comment on the price premium because they are into very, very different segment. Because GGBS, as I mentioned, for a low blend, that is sub 4,000 blend, typically sells on an ex-works basis anywhere between 2,500 to 3,000 rupees per ton. Whereas the superfines sell up of 30,000 rupees per ton, Mr. Raghav. That's the delta. But volumes typically would be very, very low for these. And these are more techno marketing related. So this is not something which is sold like uh, commoditized kind of a product like cement. It needs team, it needs the technical capability, it also needs a lot of R&D, which we are already into it. So we would want to come into that segment with lot of experience handling these materials even in the past. So that's what I would like to highlight at this point of time. But we would be more than happy to come back to all of you at appropriate time, and it's not too far. So we would be keeping you updated from time to time about the progress that we are making in this particular product. It's not only this product, but also into the solutions. Yeah, we have been engaged with some of the very advanced construction solutions where there are not many players or no players in some of the activities that we have done, which is purely technical in nature, where we definitely like to add value to ourselves as well as to the clients that we have been servicing, Mr. Raghav.
Sure, sir. Thank you.
Thank you. We will take the next question from Mr. Rajesh Ravi. Mr. Rajesh, you can go ahead with your question.
Yeah, hi sir. Good morning. Am I audible?
Yeah, very much.
Yes,
Good
you are.
morning,
Yeah.
Mr. Rajesh.
Okay, great, sir. So first question pertains to with Jeerabad grinding expansion expected to come in Q1. Would we be engaging in clinker sales in FY27 also, or they
Yeah,
will
I
be fully
think
exhausted in your cement?
I think in the current year we do expect some amount of clinker sale. Quantifying that at this point of time is definitely going to be a challenge because the ramp up takes time. So during this time,
Right.
there is a possibility that we still might do some clinker sale, but it is subject to the price of the clinker. So we never lost margin at the expense of the clinker. Uh,
Mhm.
but we do expect some amount of clinker sale as the grinding unit is likely to ramp up in a phased fashion.
Right.
So during that time, we definitely would have some clinker sale, Mr. Rajesh.
Okay, and sir, clinker margin would be at EBITDA margin level would be similar to number which you have reported in
Yeah, for
Q4.
that location, yes, sir. For that location, as a margin, as a
For that
percentage,
location.
yeah, we did not compromise in a big way because that location has its advantages, Mr. Rajesh.
Correct. Understood. Understood. Second, on the cost exceptional items, in Q4, what exceptional cost line items are there in the operating cost or one-off in nature?
Yeah, Mr. Rajesh, our CFO did update, but just for the
Yeah.
clarity sake, yeah, there is a road infrastructure as well as some DMF related expenditure at our Jeerabad unit, which actually needed clarity from regulatory this thing. So we did make the provisions. I think from here on, we accumulated for last many at least 3 years since we started the unit. From here on, it is going to be part of the operational income, and it's not very, very significant amount either way, Mr. Rajesh. It only
Okay. Okay. So
it's
in Q,
compounded. It looks higher, but from a spread perspective, from an operational impact, which we are going to make provision on a month to month, on a quarter to quarter, yeah, it may not
right.
significantly alter in a big way, Mr. Rajesh.
Okay. So in Q4, the number which you would have accrued,
Yeah,
would
it is
that be
around
the
close to 10
normalized
crores.
number? 10
Yeah,
crore.
it
No?
is close
So
to
that
10
would be
crores.
for multiple quarters, right?
Yes,
Yeah, it is
yes,
for
Rajesh.
multiple years, Mr. Rajesh.
Multiple years. So if I
Yes.
want to remove the impact for preceding period, that would be how much?
Yeah, I think Mr. Rajesh, we would revert to you with specific that information.
Sure, sure.
Yeah, but it's spread over 3.5 years. So we would again, it's a very volume specific kind of a number on ton of
Right.
limestone. So we would be happy sharing that data offline, Mr. Rajesh. But
Understood. Sir,
yeah, it's 3.5 years spread. So from a cost perspective, once we normalize it, it's not a very, very significant one. It should be less than 2 crores per year kind of an impact, if I may have to say. But with the increased volume of sale, I think that number probably on a per ton basis is going to be even tapered out to a much lower number, Mr. Rajesh.
okay. Okay, okay. And on the in the other income, there is a higher number, 11 crore. What is that pertains to? And is there any land monetization which has happened?
You're talking of
Other
inflows,
income, 11
Mr.
crore.
Rajesh. I think it's mostly to do with the incentives that we received, Mr. Rajesh, during the current year quarter.
Oh, that would be what I understand. That would be part of your revenues, right? The Jirabad
No.
incentives.
Yeah, Ravi, the
Yes,
other
sir.
income is the income on YFS. Say we diluted stake in Andhra Cement. So
Ha
that
ha ha.
other income is inclusive of that.
Understood. Okay, understood. And lastly, is there any guidance on the superfine business for on revenue and EBITDA? I understand it would be too early, but any ballpark number you're working with for FY 27,
Yep.
28?
Yeah, Mr. Rajesh, I think we would revert with very specific presentation pertaining to that in due course of time. Kindly bear with us. But what we do
Done.
expect is up of 30% kind of a margin as a minimum uh,
Mm-hmm.
in that business line. But the top line and the bottom line numbers, we would be happy to come back to all of you. Kindly bear with us till the next quarter end, please.
Understood. And lastly, on the operating cost, with the clinker unit at Andhra also stabilized. So, excluding the fuel price increase and the packaging cost increase, have our numbers stabilized? Are there rooms for further reduction in the operating cost? Hello? Hello?
Shrikant, sir, we can't hear you.
Shrikant sir, Prasad sir, we can't hear you.
Yeah. Yeah, Rajesh, I think there is some disconnect.
Okay,
Shrikant sir will rejoin again.
sure. Okay. So maybe if you could answer, what sort of cost normalization which is still expected in, on the company level, now because this is second quarter, your
Yeah,
Andhra Cement.
post commissioning of preheater at Andhra, so it is in line with the sector right now. So yearly rate is close to 200 to 250 rupees per ton, higher when we compared with other units of us, and even in line with the sector. So now post commissioning, everything the fuel related and all, it comes back to normal. So today we are incurring around 700 to 700 kcal per ton of clinker. So that's what earlier it is around 775 to 780. So once now at clinker level, it is normal. Going forward, we are going to commission the new VRM for the cement grinding that is going to be commissioned by September this year. So post that, the overall whatever cost saving we estimated, we are going to achieve with that.
Okay, and given the current scenario, any guidance on the margins? Can we expect, further improvement in margins from, this quarter margin performance for 34, 40 rupees level or?
Yeah, definitely, it is going to be in line with the sector right now. Yeah, it is going to be in line with other units of Sagar. Yeah, we have to see going forward based on the cost pressure, and again, it is correlate even onto the cement price. So probably this year we were expecting it is going to be better than the last financial year.
Understood. Great, sir. Thank you. I'll come back in queue.
Thank you, sir.
Thank you. We will take the next question from Mr. Satyam Kesarwani. Satyam, you can go ahead with your question.
Yeah, hi. Hi, thanks for the opportunity. I'm audible.
Yes, you are audible.
Okay, great. So my first question would be about overall market, sir. Overall in South particularly, if you could just tell us about the pricing trend, across South region and overall for all markets as well. It'll be great, please.
Yeah, we took the price increase during second week of April, yeah, across all the regions. Across all the regions, yeah, we are able to achieve close to 25 to 30 rupees per bag, most of the regions.
Yeah, Prasad,
Considering the
let me
yeah,
address
please.
that. See the price that we have seen right now in Hyderabad, from a retail price perspective, we are close to 295 rupees, sir, which was at 290, and the wholesale price was hovering at 225, which actually got increased to 268 uh, by 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 exit of April to even the current price. Yeah, as I mentioned earlier, we did get 25 rupee kind of uh, per bag price hike. If you look at Vizag, yeah, the current retail price is at 295 with the wholesale price reading around 265. Again, it's product specific. For each market, there is a specific product. For Hyderabad, it is PPC. Yeah, now you look at Sholapur, the current price is at 288. Barampur, the price is at 280, 295. Bhubaneswar is at 300. Indore is at 278. Bangalore is at 310. Chennai would be close to, again, this is our for our product. Yeah, we are typically in a B segment, B category segment. It's hovering anywhere between 290 to 295, Mr. Satya.
Understood, understood. Thanks for that, sir. Sir, is the price is it sustaining? Is the demand
Yeah,
there in the market?
as I mentioned, sir, the price picked up primarily in a non-trade segment in the middle of April. Though we tried to increase at few places, price more or less remained where it was without any kind of price increase uh, till 15th of this month, or rather till 12th of this month. In some places, of course, we did see whatever we tried to increase, especially in the eastern India, to certain extent to in indoor markets. Yeah, the 5 rupees increase that we attempted, we could not sustain. So prices more or less have been very, very flat, with slightly negative bias in the central as well as in the eastern markets for us. Whereas in south, we could sustain the same price what we have increased middle of April. Even so far, it is holding up. Though I have to admit that the additional price increase we could not get, but more or less the prices remain where they are.
Understood, understood. So my next question would be about the incentives. How much incentive did we book in this quarter and for the whole year? And also, what are we expecting for the for 20 FY27, if that could be given?
See, our incentives primarily receivables in Telangana remain where they are, so there has not been much. But we expect some amount of incentives to be picked up where we have accumulation of around 100 crores for last 10 years. Yeah, we have seen a small trickle down in Andhra. We are not penciling in either of them. The only incentives which we have been receiving consistently is from our Madhya Pradesh asset. Yeah, we expect anywhere between 25 to 30 crores for the coming year, Mr. Satya, for the Madhya Pradesh asset.
Understood. So my last
On
question
account
would
of
be
both capital subsidy as well as some amount of electricity incentives that we have.
Okay, okay, got it, got it. So my last question would be about your sale mix across the states. Like, uh, what percentage did you sell across your
Yeah, I
region?
think we made it part of the presentation. If you look at our investor presentation, it's on slide 6, Mr. Satyam. I think it is very elaborate. Rather than giving you a number, you need any further refinement to that, we would be more than happy to furnish. But we did indicate those in our investor presentation, investor and
Okay,
analyst presentation,
sure,
Mr.
sure.
Satyam.
I'll have a look. I'll have a look. Thanks.
Thank
Thank you.
you. We will take the next question from Mr. Kamlesh Bagmar. Kamlesh, you can go ahead with the question.
Yeah, thanks for the opportunity, sir. Sir, one question with regard to your MP plant. So just wanted to know, like, how much incentives are available, like, say, for will it continue till FY30 or how much we can expect there?
Yeah, Mr. Kamlesh, the incentives there are to tune of around 171 crores so far. We are also eligible for the expansion project additionally, but this 170 crores is spread over 7 years. This is primarily on the capital subsidy, sir. So is the case with the electricity incentive. So these are valid for 7 years. Out of that, we are close to completing three and a half, three, close to 3 years now. So they are available for next 4 years, Mr. Kamlesh. I'm talking only of the first asset that we have built. For the expansion project, yeah, they would be available for next 7 years to be paid in 7 equal installments for the overall kind of incentive. Yeah, we would revert to you once the capex is firmed up. There is a government sanction which we need to get. So for the expanded project, once we get to know of the numbers, we would be happy furnishing. The numbers that I've indicated is for the first investments that we have done.
So in total, for the first phase, we are expecting 170 crore, and out of that, we have already got roughly around 100, around 170 odd crore. Like say last year,
Yeah,
if I see,
close to that number, sir. Close to 65 odd crores we did receive. Yeah, we have another 110 crores to be spread over 4 years' time. Added to that, we would also have an electricity incentive, which again is a performance driven. So we are not able to quantify that at this point of time, but that should be anywhere between 7.5 to 10 crores additionally over what I mentioned, Mr. Kamlesh.
and lastly, sir, if you see standalone performance, our margins look to be very subdued. So like say below 150 mark. So where do we see these margins? I do understand that prices are not under our control and we can work only on our cost part. But like year after year, we are seeing this performance, and on top of that, we have seen a benefit of consolidation in the industry as well. But overall, the performance looks to be very subdued. And what are our aspirations, like say over next 1 to 2 years? Where do we see our these margins going?
Mr. Kamlesh, I'm sure you would appreciate. I think the Andhra has been a significant drag on us in terms of Andhra cement. Fortunately, the capex and everything is working out extremely well. So you'd have seen even in the last quarter, yeah, we are very close to the break even. I think with the turnaround in Andhra, I think from a cost perspective and everything, we are back to where we were once. But for the pricing on the cost front and all, we are back to a very good kind of a position with Andhra new preheater coming up. The efficiency of the new preheater is extremely good, and at the same time, our investments which we have done over last 3 years, we are extremely confident on our margins going forward. Uh, Irrespective of the prices, I think we should start delivering the numbers from here on, Mr. Kamlesh.
Great, sir. Thanks a lot, and best of luck.
Thank you.
Thank you. We will take the next question from chat box. Mr. Shikhar Maipal wants to understand about the state-wise price hike and demand outlook for the state.
Yeah, as I've indicated indicated for most of the southern states, we did get 25 rupees per bag on an average kind of a hike starting from middle of April. As indicated earlier, we are able to sustain most of it. The growth numbers from what we did narrate even during the previous call, yeah, we do expect a strong demand growth in both Telugu states of AP and Telangana. Yeah, we do expect anywhere between 5 to 10% growth in Tamil Nadu. Karnataka, we expect a 5% growth in for the coming year. Going back to Odisha, there has been a lag, but fortunately, the government spend has started picking up. But internally, we did pencil a 5% growth for the demand for Odisha. For Madhya Pradesh, we are expecting anywhere between 5 to 7.5% growth for Madhya Pradesh markets.
Thank you. And another question is from Mr. Maheen Bhardwaj. So he wants to understand the expected cost increase. Like 100 and 150 per ton is attributable to petcoke cost. So what about the other high cost, like for example, bags, etc.?
Yeah, I think bags there has been a taper down from what we have seen. We were paying extra 5 rupees to an average cost that we used to pay before. We have seen almost a 2 rupee kind of a drop per bag. It has come down. Uh, but the real impacts of war, I think we just started seeing them. So given this scenario, yeah, what we have penciled in is almost additional another 100 rupees on account of all the miscellaneous things that includes the bags and at the same time availability and also the pricing of explosives. Also, there has been a 23 rupees 75 paisa per liter hike in terms of commercial diesel, which has its impact on the mining. So we have penciled in almost additional 100 rupees. So we are factoring around 225 to 250 rupees per, per ton kind of a price increase on account of both fuel and as well as miscellaneous expenditure. I'm talking this in general. Yeah, it could vary on the inventory and all. Yeah, that's what is what we have penciled over a period of time. Again, this is kind of a moving number. As it stands, that's what we have seen. If everything had to be passed on at this point of time, uh, it is impacting almost 250 rupees per ton on account of fuel and various other cost items that have gone up during this time.
Thank you. We will take the next question from Mr. Indrapreet Bansal. Indrapreet, you can go ahead with the question.
Sir, just wanted to know, actually, I have joined late. Sir, any update on the land disposable, the timelines on the land bank, and when can we expect the proceedings?
Yeah, see, I'm assuming that you're talking of the Vizag land of Andhra Cements.
Yes, yes, sir.
Yeah, we got all the approvals. So the government indicated that they are preparing a final GO, not for us alone, but in general, for monetizing all the industrial lands which the grant has come from the government historically. So, like in Telangana, where the government promulgated a government order uh, where there is a small fee which we need to pay to the government and it automatically gets converted. So even Andhra government is contemplating similar kind of an act GO. We are just awaiting for it. But some of the critical approvals we have received primarily from GVMC, that is the Greater Municipal Vizag Municipality and the Urban Development Authority. We did get the approvals, but yeah, the GO from the government is awaited. We were to receive the GO, but specific to us, but government wanted to come up with a generalized kind of a GO to get most of these conversions simplified. They wanted to come up with the GO. So we are expecting any time it might come. So at this point of time, it is still fluid, but we are more than hopeful that over next 6 months we should have got the GO in place for us to monetize, Mr. Indrapreet.
Thanks a lot, sir.
Thank you. We will take the next question from Mr. Rajat Sethia.
Yeah,
Rajat, you
thanks.
can go ahead with the question. Yeah.
Yeah, thanks again. Sir, last year at the starting of the year, we had guided for net debt position of around 1300 crore, while we ended the year at almost 1550 plus. So what really happened that, we had to take more debt, and what gives us confidence that the number that we have put up for the next year debt, we will be able to achieve it?
Yeah, what you have to remember, Mr. Rajat, is this debt includes uh, an unsecured debt from the promoter group for fulfilling the Andhra project. So we were not wanting to draw the entire amount. If you track us, we were to do the rights issue for Andhra, yeah, which we could not do the rights issue, but we went for an OFS. So that actually has elevated. We always have indicated that the debt levels would not be higher than what it is. So that uh, we would not cross the current levels. And at the same time, yeah, we did accelerate some of the solar investments and everything, which where the payback period was fairly short. So that is actually adding up to our EBITDA or rather cost level. So we thought that is more prudent than trying to keep debt at the static level. But having said that, yeah, from here on, we expect debt to be paid out fairly quickly with the operating income, Mr. Rajat.
So thanks, sir. And in terms of our EBITDA per ton, there was a time when we used to do 700 rupees per ton basis. Do you think we are in a position to go back to those levels in the next 1, 2 years?
I think in the current year itself, we should be very close to 600 because the significant improvement for us has come from the cost itself, Mr. Rajat. So the last year ended at almost 450 to 480. And we are more than hopeful that with the Andhra plant becoming as efficient, with both the grinding plants becoming operationalized, for us, adding this 150 is not an external issue, it is more an internal issue. And we believe that the current pricing may not deteriorate. That's the caveat that I need to put. Even if it doesn't go up, with the current prices remaining flat, I think we should be close to that number, Mr. Raj. It's primarily on account of the savings that we are getting from the investments that we have made so far.
Okay, and these internal investments that will contribute, the timeline wise, by when they will start kicking in from
Sir, I think
Q2?
Andhra is already operationalized, especially on the clinker line. The waste heat recovery as well as the grinding capacity at Jeerabad should be completed before end of this quarter itself. Though three-fourth of the WHRS is already operational as we speak. But before end of the quarter, we are more than hopeful that these savings should start kicking in at the levels that I've indicated. Andhra's grinding capacity, which again should also save on the energy side, should be completed before end of September itself, Mr. Rajat. So that also should start contributing for half of the year, half year for the current financial year.
Got it, sir. Got it. Thank you. Thank you.
Thank you.
Thank you. We will take the next question from Mr. Rahul Agarwal.
Thank you for the opportunity. This is a continuation to the last participant's question. How much capex is pending for us to be incurred on both the Jeerabad expansion as well as on the Andhra Cement side? And how much will be incurred in FY27? And by when do you expect both of these units to start commissioning?
Yeah, I would appreciate if you could look at slide number 16 on the presentations that we have uploaded, Mr. Rahul Agrawal. Yeah, just for the convenience, uh, the Andhra expansion, the pending capex is close to 140 crores, which we are likely to complete in the current financial year. Gudipadu is at 17 crores, and Jeerabad expansion, we have 33 crores pending. As mentioned, the Jeerabad expansion should be completed before end of this quarter itself. So is the case with the waste heat recovery at Gudipadu. Andhra's expansion should be completed before September, sir. This September.
Got it. Got it. Got it. And on the Vizag land, you mentioned that a lot of clearances are in place and you're still awaiting the final notifications from the government. But as of today, what is your assessment of the market value of that land?
Yeah, again, I'm going with the reckoner rate, sir. Though there has been some increase, but I'm going with the old reckoner rate. It is at 4 crores an acre. Net of expenditure, we are likely to receive around 3.5 crores per acre. And we have around 100 acres. So we were expecting 350 crores spread over 2 years' time. When the GO gets received in the first year, we expect it to receive around 150 crores and the 200 crores over the next 12 months' time post that, Mr. Rahul.
Got it. And one last one, sir. On top of the expansion capex that you highlighted earlier, is there any recurring maintenance capex that we need to do, and what is the quantum of that you expect on an ongoing basis?
Yeah, again, we did present part of our presentation, sir, just for the convenience at each location. The general maintenance capex across all the units should be around 50 crores, sir.
Got it. Got it. Thank you so much, sir.
Thank you.
Thank you. We will take the next question from Mr. Parth Bhavsar.
Hi, sir. So thank you for the opportunity and congratulations on good set of numbers. Sir, I just had one question which is related to balance sheet and more on working capital. Your working capital days has increased significantly, from March 25 to 26, and this is largely driven by decline in payable days. Can you throw some light on like what happened during the year, and also how do you see this going forward?
Yeah, I think when market situation is very, very difficult, sir, the credit days and everything gets extended. At the same time, as indicated, the fuel prices were at elevated levels. So when you stock up, you end up using higher working capital. Uh, I think by end of the year, we more or less have reached to stability. And I think going forward, yeah, we would like to minimize the utilization of the working capital. But this happened because the business itself has expanded, sir. If you look at the working capital limits were very similar, even for a 5 million sale, but the sale got extended. So was for some of the clients, the credit days also got extended. So that definitely put some amount of pressure on the overall kind of working capital utilization. But we expect a moderation going forward. But please keep in mind that we are going to add another million-ton sale into the overall kind of numbers what we have done previously. So there is some amount of reassessment with especially the fuel with the increased price for same volumes. If we have to do, still, yeah, we need to put in more money. So I think that's the scenario that we are in. But with slightly better realizations and better margins, we do expect moderation in the overall kind of utilization of the working capital, Mr. Park.
So largely payables is linked to basically or raw material stocking up, fuel stock up. Yeah.
It's
And this
on either
this should,
side, sir. One is the credit days
yes.
for the finished products, and at the same time for the raw material for the input
Yeah,
material.
in addition to that, in Q4, in the month of March, we secured close to 76,000 tons of US NAP coal, which is close to 80 crore worth of value. So that we took based on the by sharing the foreign letter of credit. So that is going to have 180 days credit period. So that is one of the reason to reflect the higher numbers.
Okay, perfect. Got it, sir. Thank you so much for answering my question.
Thank you.
Thank you. We will take next question from Mr. Rajesh Ravi. Rajesh, you can go ahead with
Yeah,
the
hi, sir.
question.
Yeah. Thank you. So my question pertains to your discussion on saying that net numbers would largely remain flattish. So just wanted to understand first in the working capital, what is the incentive outstanding at the end of March 26?
Prasad, can you
Yeah,
help me with that?
Rajesh, it's around 23 crore we have to receive incentives.
Oh,
Receivable.
great. So most of the around 67, 68 crore, which is accrued in PNL,
Yes,
large chunk of that got received this year.
Yes,
That
sir.
was
Yes, sir.
23.
Even this 23 crore we were expecting in second quarter.
Okay,
Yeah, yeah. So post,
understood.
yeah, since now the numbers are in place, so now we have to uh, reach government to submit an application to get the money. So that we are going to initiate probably in the next week. So we were expecting somewhere in mid of July, we can get the incentives.
Understood. And sir, when we're talking this year, we are talking of total capex of close to 300 to 320 crore, including maintenance capex, and interest outgo, if I'm not wrong, would be close to 200 crore. So somewhere north of 500 crore of cash flow would be required. And if we assume all of that comes from EBITDA, we are talking about at 7 million tons.
Yeah, Mr. Rajesh, I think, yeah, sorry for barging in. I think you
Sure,
should
sure.
understand that CapEx need not come from EBITDA alone, sir. Yeah, we have
Mhm.
structured even some of the energy efficient projects through lease finance. But yeah, except for the spending three and the maintenance capex, the other projects are subject to the market conditions, and at the same time, based on the payback, we would like to take a call with lease finance options that exist for us, Mr. Rajesh.
Okay, okay. So from a cash flow perspective for FY27, what the capex outgo you're looking at? I understand you have few leased out projects also.
Yeah, it is close to 140 to 190 crores is the total capex that is pending for three ongoing projects, Mr. Rajesh. But there is undrawn credit,
Right?
and our draw plan is whatever we would have repaid, that is what is required for us to implement the project. So that is precisely is the plan, and that's what we did indicate in even in our presentation, Mr. Rajesh.
I was looking to your presentation where you mentioned 290 odd crore is what you're looking at.
Out of that, if you look at
275 crore.
yeah,
Uh-huh.
there are three projects which are subject to two of them are solar, both at Matampelli as well as at Jeerabad. And at the same time, Gudipadu, in terms of optimization, sir,
Mhm.
those are options which we would like to exercise as we would progress. But our interest is to pay down the debt. So we are looking at other alternatives to implement the project, primarily on something like an equipment finance kind of an option or lease finance option is what we are pursuing,
Okay.
Mr. Rajesh. So once
Mhm.
you remove that,
Understood.
we should be sub 240 odd crores. That includes the maintenance capex, Mr.
Okay.
Rajesh.
So that would give you some. And any land sale you're factoring in your assumptions when you're expecting your
Yes, sir.
net debt numbers to be flat?
Yeah, we did pencil in close to 150 crores for the current financial year.
Net of taxes,
Yeah, that is
net
net
of
of
expenses.
expenditure. Yeah, net of all the other
Okay,
expenditure.
understood. So that will means you're factoring in close to 500 odd rupees, at the EBITDA margin level. And so on cost
Yeah,
side, if I look at yours, yeah, please tell me, sir.
from a budget perspective, we have penciled in 580 crores, sir, which is 100 rupees more than what we have achieved last year.
Mhm.
As I mentioned before, that 100 rupees is actually coming from the overall savings that we are likely to receive in the cost optimization alone, Mr. Rajesh. What we have also penciled in is whatever would be the incremental costs that are likely to happen from here on, we are assuming that it would be a pass-through where market should absorb them, Mr. Rajesh.
Understood. Correct, correct. And if I just want to understand the OpEx breakup between your standalone and Andhra Cement, they are at quite different cost levels. So if I look at your operating cost for your standalone entity, that averages out close to 3,800 rupees per ton, and the
Yeah, Mr.
Andhra
Rajesh,
Cement.
I'm sure you'll appreciate that is one of the reason why even in a difficult time we went with an investment, because whatever we invested in
Correct.
Andhra has a very strong payback. Now with the investment more or less coming to conclusion, yeah, the gap between Andhra and standalone should be very, very minimal, sir. Because the gap again, very specific to Matampelli to Andhra, the gap would be only the waste heat recovery cost related issue, or else more or less there is a complete alignment on cost. That's what gives us confidence that from here on our margins are going to be, I would not say very high, but healthier like how it used to be before. Uh, that is one of the reason why we aggressively pursued the capex even in a difficult time.
Understood. So I see one 1,000 rupee difference between both the entities on costing sides, 38,900 versus 48,900. So am I missing something? Andhra OPEX is close to 4,900 or on a full year basis?
Yeah, Mr. Rajesh, again, it depends on what are all the line items that you're looking at, because the logistics cost could be very different because the market spread is very different. But I think we would be more than happy to run through uh, on and offline, Mr. Rajesh.
Sure. Sure. And lastly, on the land sale, I understand the GR you're expecting from the Telangana government. But in the interim, have you lined up or are you in some advanced stage of discussion with buyers? So once the GR is out, you may be able to dispose of and generate that
Rajesh, I
140
think
crore you're looking.
yeah, there has been an engagement, but
Okay.
as you know, everybody needs clarity, right? So we obviously
Yes.
have appointed a consultant who has helped us to reach out to few of them. Yeah, we are in discussion, but nothing is concrete till the timeline and everything gets evolved. So that I think, yeah, and it should not be a big challenge selling a land in Vizag, though that size of land for Vizag is very big. But with the activity that is happening in Vizag now, we are reasonably sure and confident of executing the transaction fairly quickly, because our idea also is not to sell it as a single block. The idea is to make it into viable blocks so that yeah, we don't have to break it down into smaller pieces, but some manageable pieces. I think sale should not take longer than 2 years, Mr. Rajesh. So that is the reason why we penciled in the entire 350 crores spread over 18 to 24 months, with bulk of it, around 150 to be received in the first year, and the rest in next 6 to 8 months, the balance to be received, Mr. Rajesh.
Yeah, that's all. Thank you, sir, and all the best.
Thank
Thank
you.
you.
We will take the last question from Mr. Rajat Setia. Rajat, you can go ahead with your question. Rajat, you can unmute your line and go ahead with your question. Since there are no response, and as there are no further questions, we will request management to give the closing commentary. Over to you, Shrikant, sir.
Yeah, thank you again. Appreciate each one of you for joining on the call. I hope you could get all your queries answered. If not, please feel free to connect us at Sagar or Celia. We would be more than happy to address them. Thank you again. Have a great day here. Thank you.
Thank you. And now we will conclude the call.